Top 10 Tips for 2015 Canadian Tax Return, Part 2 Feed. Medical expenses. This year, costs for the design of personalized therapy plans for those eligible for the disability tax credit and the cost of serviced animals used to help those with severe diabetes can now be claimed. Be sure to claim your medical expenses on the tax return of the lower income spouse. This could save you more tax since your claim is limited to $2,171 for 2014 or 3% of net income, whichever is less. Volunteer tax savings. If you are an emergency services volunteer, you might qualify to claim a $3,000 amount on lines 362 volunteer firefighters or 395 search and rescue volunteers, which is new for 2014. Alternatively, you can claim an exemption for up to $1,000 of income paid to you as an emergency services volunteer. But you can't claim both the $3,000 amount and the $1,000 exemption. You will likely be better off claiming the $3,000 amount. A tax pro or tax software can help you make that decision. Lifetime capital gains exemption. If you happen to own qualified small business corporation shares or qualified farm and fishing property, you may be able to shelter from tax up to $800,000 in capital gains on the sale of those assets. The rules were simplified this year to accommodate those who do a combination of farming and fishing. Check out Canada Revenue Agency CRA Guide T4037, Capital Gains, or speak to a tax professional for more information. GST or HST credit. If you're entitled to the GST or HST credit paid based on family net income, it used to be that you had to apply for the credit on your tax return. No longer. When you file your tax return, Canada Revenue Agency CRA will now determine your eligibility and will tell you if you are entitled to the credit. Automobile expenses. The rules surrounding motor vehicle expenditures in relation to rental property operations can be confusing, particularly when an investor owns only one rental property. You can only deduct reasonable motor vehicle expenses if you meet all of the following conditions. 1. You receive income from only one rental property that is in the general area where you live. 2. You personally do part, or all, of the necessary repairs and maintenance on the property. And 3. You have motor vehicle expenses to transport tools and materials to the rental property. The Canada Revenue Agency specifically states that you cannot deduct motor vehicle expenses you incur to collect rents. The Canada Revenue Agency considers these to be personal expenditures. Note that the rules differ if you own more than one property. Mortgage payments of rental and investment properties. A frequently misunderstood deduction is mortgage interest. It is only the interest portion of your mortgage payment that is deductible. The principal portion of your mortgage payment, while a major factor in the cash flow of your investment, is a repayment of debt, and thus not a deduction from taxable income. The Canada Revenue Agency CRA Voluntary Disclosures Program allows taxpayers to fess up about something on their current or past tax returns that may not pass the smell test. Doing this can prevent additional penalties from being assessed. But for the disclosure to be accepted, you must contact the Canada Revenue Agency CRA before it contacts you. Repairs and maintenance of rental properties. Repairs and maintenance are a very tricky area from a tax perspective. Generally speaking, when you make small repairs or routine maintenance to your rental property, you are incurring a current expense and can immediately take this as a deduction against your rental income. Renovation versus repair expenses. The situation becomes more complicated when you are making larger expenditures. For example, If you were to tear out an old, outdated but functional washroom in your rental property and replace it with a brand new modern one, you are probably making a lasting improvement to your investment rather than a simple repair to a broken component. In this case, you would not be permitted to deduct the expenditure. Instead, you would capitalize the renovation and depreciate it over an extended period of time.